Hello and a warm welcome to Portfolio Watch. I'm Gugulethu Mfuphi. Now in today's program, we talk about dividend aristocrats. While they are rare and are good to have in your portfolio, to quote Benjamin Graham, a great company is not a great investment if you pay too much for the stock. To talk to us about this theme regarding valuations, how to identify a great dividend payer, and of course making sure that they stick by those principles in the long term, I'm joined in studio by Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Nick Norman-Smith, Chief Investment Officer at Lentus Asset Management. Gentlemen, a great pleasure to have you both, and thanks so much for making time. Well, we know what a dividend is, but of course when we take a look at dividend aristocrats, it's a theme maybe that some investors aren't very familiar with. Introduce us to this, Andrew.
Yeah, so I think don't confuse it with a high yield strategy. Dividend aristocrats are typically companies that have been able to maintain or increase their dividends over 25 years.
That's a long time, and we know that
can get
tricky.
That's a very long time. So if you're looking in South Africa, I think you're going to be hard pressed to find a South African dividend aristocrat. I think, you know, the likes of Naspers, which isn't known to be a high yielding stock, has actually been a very good dividend payer over a very long time. So there's a subtle difference between being able to pay and maintain or sustain dividend payments as opposed to being a high yield stock. So if you're just looking from a high yield point of view, you may end up with, you know, what you call value stocks, you know, your deeper value as a result, you know, lower price, higher yield. That doesn't necessarily say they're able to sustain that dividend over time. So looking for aristocrats is businesses, you know, that can sustain earnings, high cash generation, and pay out, or have a dividend policy that pays out regular payments to shareholders.
How tricky is that though? Because we know we're facing so many headwinds from macroeconomic conditions. If you look at the last 10 years, celebrating the 10th anniversary of the global financial crisis and many other themes. So that certainly must make it very difficult for management and board members to actually agree to stick to such dividend policies.
It's incredibly difficult. As a result, that's why there's so few of them around. And you typically find that they will be in certain sectors. Certain sectors are going to be, you know, more susceptible to having dividend aristocrats in them, like your healthcare businesses, possibly more defensive companies. I know we'll talk about a few of them later. So it's not a very easy thing to do.
Nick, if we rope you in now, of course, valuations are also a very critical theme to identify here, given the comparison that Andrew's made to high-yielding stocks. What are the sweet spots that we need to be able to identify in this particular regard?
Yeah, I think that's the key. You know, all of those characteristics are great. Who doesn't want a company that's got high cash generation, sustainable cash flows, you know, sort of long history of you know, generating high profits, etc., etc. So because of that, so many of these businesses are very expensive, and that often leads to poor returns. So to be able to find a business like this that is both a great business, has a good outlook, and is cheap is even more difficult to do. So what you've got to do is often find businesses in areas that are under some short-term pressure, but you believe, and clearly the market doesn't, that they're going to come through that and continue their history of you know, of strong cash generation. So be careful to not get caught into a value trap that looks cheap, but actually the business model is no longer sort of
in my mind. I just had a quick flash of resource stocks in South Africa, which have actually seen quite a bit of value. Would that be a typical example perhaps of a sector which is now bubbling under and showing some positive prospects in this regard?
Yeah, not really, in that the resource companies are so cyclical that they don't have the earnings sort of capability to pay consistent dividends. Unfortunately, what you often see with resource companies is they pay high dividends and they buy back shares at just the wrong time. Whereas a lot of these aristocrats will be buying back shares at the right time and paying consistent dividends sort of through the cycle. Unfortunately, the resource companies, because of the nature of their businesses, often get that cycle so wrong.
I do also want to take a look at the international comparisons. You did mention that the South African environment is quite tight, but internationally and in the US specifically, I understand there's an index that also monitors these dividend aristocrats. Are there some surprising stocks that actually feature on that list, Andrew?
Yeah, so I mean, it's not just the US. So you can actually buy, I think there's a ETF, a local ETF that's a dividend aristocrat. So looking at, you know, your companies that can do this. So it's not just a US. You know, you don't only find US companies, but typically US companies, a lot of them have been around for a very, very long time. You know, and they've got management that have, you know, sensible, I suppose, dividend policies and capital management. I suppose it talks to capital allocation. But just because you're a dividend aristocrat, Nick touches on the fact that, you know, these companies might be quite expensive, typically because it would lend yourself to these companies being fairly high quality businesses with, you know, solid sustainable earnings through the cycle. You know, so you do have to be aware of the valuation. It's not just US companies. You can find an Aristocrat anywhere around the world, but typically US companies have been around for a number of them have been around for a very, very long time.
Just before we do touch on the stocks, we know that where there is an investment opportunity, there's also substantial risk, right? Any particular risks that retail investors need to be cognizant of when identifying dividend aristocrats?
Well, I think just going back to, again, I mean, we were saying this isn't a high dividend yield strategy, but still, you need to understand the underlying cash flows of the business and the state of the business. Make sure that those dividends are going to be sustainable, whether it's low yield or high yield. These businesses need to be able to continue to generate these cash flows. So don't get suckered into a high yielding stock when the underlying cash flows are probably going to be quite significantly different in the future.
Oh, well, that's it. Let's certainly get into identifying some of these key stocks that are ripe for investment and identified as dividend aristocrats. First stock on our list is an international one, Johnson & Johnson, and many of us are familiar with this particular brand, far-reaching and of course been a very significant performer here. Andrew, what adds to its investment appeal?
So I think, you know, if you're thinking about a dividend aristocrat, this is probably one of the stalwarts of them. I think it's increased its dividends for 57 years. Sure. So it's a dividend aristocrat 2 times over. It's been around for 130 years. So it's a very old, well-known company. You know, it's got a very strong brand. So when you talk about economic moats and being able to, you know, continuously derive, you know, high returns on equity, being very profitable, Johnson & Johnson is able to do this. So it's obviously a pharmaceutical business, or thought of as a pharmaceutical business, but it's actually got 3 divisions, which I think separates it from some of the other pharmaceutical companies. So it's got its, you know, obviously pharmaceuticals, medical devices, and then consumer products. And I'm sure all of us are familiar with Johnson & Johnson's consumer products. So it's a very, you know, stable earner. One of only 2 companies, by the way, that has a AAA rating from S&P 500. Sure. You know, higher than the US government is its credit rating. You know, so it can raise capital at very, very low interest rates, very profitable. You know, and these companies have to continuously, you know, evolve and replace medicines, you know, as the patents run out, and they're able to do this. The other company, by the way, is Microsoft.
Ah, interesting you mentioned that.
If you're wondering, yeah. So, and then from a valuation point of view, you know, on a forward PE of, you know, mid-teens, it's not that expensive. It's not a dripping rose by any stretch of the imagination, but, you know, Nick alludes to this valuation, and when you get these companies that are able to pay these dividends, you know, year on year, typically it leans itself to high quality companies, which would warrant maybe a slightly higher valuation. But by no means is it overvalued. You
do mention that Johnson & Johnson is a dividend aristocrat 2 times over. Does that have any bearing with regard to the fact that it is a family-owned business, or perhaps the ethos of, you know, it paying out a sustainable dividend year after year is actually ingrained in not only their policies but in the culture of management and board executives as well? Yeah,
absolutely. So I mean, it gives you a very clear view of the boardroom thinking, I suppose, within the company that, as you say, must be ingrained for a very, very long time. You know, I don't see them not paying a dividend at any time in the future. So definitely, I think it's something that is ingrained within the boardroom.
Let's move on to the asset management space, and I want us to compare the likes of Coronation versus Franklin Resources. And Coronation is one that you're quite keen on, right, Andrew?
Well, if we're thinking of dividends, Coronation, you know, there's few companies that pay out as much of their earnings on the JSE as Coronation does. So when you talk about, you know, certain sectors, you know, lending themselves to businesses that pay out dividends or may become dividend aristocrats, financial services is definitely one that pays good dividends, but the sustainability of it is, you know, slightly questionable because it's highly geared towards the economic cycle. Yeah. But if you're thinking about dividend payments in the financial services business in South Africa, Coronation essentially pays out 100% or very close to 100% of their earnings in dividends. So it's unsurprising to see them on a dividend yield of 8%, or 8 or 9%. But this is now when it comes into question, you know, your valuation. Are you just buying, you know, deep value here, or you know, are their dividends going to be able to? Are they going to sustain them and grow them, you know, for a very long time into the future? Their dividends are fairly cyclical. Given what happens, it's a geared play to the market. Depends on their performance. We know performance is transient within any asset manager. Yeah. You go through dips of good performance, bad performance, and then you see the flows. They've also got a nice mix, I suppose, of institutional and retail clients. So if you're looking for a nice dividend payer, Coronation would be it. I don't expect them to grow their dividends year on year, but they will continue to pay very generous dividends.
Nick, would that be a theme across many asset managers, asset management players that we see globally?
Yeah, absolutely. And these are generally, one would think they're going to make slightly better capital allocation decisions given that they're in the business of managing assets, as opposed to being in a cyclical business that might have so much cash coming in they actually don't know what to do with it. But yeah, valuation is interesting. An interesting way to look at asset managers is to look at their enterprise value as a percentage of their assets under management. Cora's has been as cheap as 1%, so the lower the better, and as high as 6%. It's sitting at about 3% at the moment. So about mid-range valuation. Look at the industry and say, well, what are the future prospects? Well, margins are probably going to come under pressure with passives. You know, there's obviously some issues in South Africa, and if our economy comes under pressure, their earnings will as well. So, yeah, well-run business, very sort of employee and management owned. Valuation not particularly exciting, but not as expensive as it's ever been.
Yeah, and as it compares to its international counterparts, Franklin Resources, I understand, is one of those that you've monitored quite closely.
Yeah, so it's not a resource company. It actually owns the Franklin Templeton brand along with a few others. So yeah, big business, about $700 billion of assets under management.
They're really diversified with their investment spread, right?
They are. Quite a lot of emerging market exposure, which is why they've been under pressure. They've also been under pressure because the overall industry is under pressure. So from their valuation point of view, they've been as high as 5% EV to AUM and as low as 2%, where they're sitting right now. In addition, they've got around $8 billion of sort of spare cash, net cash sitting on the balance sheet. They have a market cap of $17 billion. So very, very cheap, very strong dividend payer, very astute at buying back shares at the right time, and around 40% owned by the founding family. So all of those boxes are ticked. So maybe active asset management is dead, but if it's not, paying that cheaper price could get you a very good return and great margin of safety given the low valuation.
Given the two companies that you've highlighted, of course, having a history and deep entrenched amount of experience within not only the South African environment, but internationally too, how does sentiment, especially around the 2008-2009 global financial crisis, actually impact these businesses? Did we see a dip perhaps come through there? And, were there particular ways within which both these management companies were able to continue paying out a dividend despite those negative headwinds?
I think when you think about the size of them, so markets play a very, very big role in the size of the AUM. So when you've got a huge amount of AUM, or assets under management, as you call it, inflows and outflows may not be as material as a market crash of 20% or the market going up 20%. As the market goes up, so do your assets under management, so do your fees, management fees, etc. So I think the bigger you are, market moves, so the global financial crisis would have had a material impact on them because they would have, their assets under management, as a result, their fees would have taken a big hit. But if you think about these businesses, there's a hell of a lot of asset managers out there. Very large number of small asset managers. So barriers to entry are fairly small, but barriers to success, I think, are quite big. Because you've got to be around for a long time. You've got to build your track record, etc. And I think when you're thinking about investing in these businesses, it's a far safer bet to go for your larger established asset managers that have the track record in place.
Clients want that familiarity and, of course, that nod of confidence to see the past performance. Well, we've certainly given you something to think about. You can, in the meantime, continue joining our conversation by tweeting at CNBC Africa, use the hashtag PortfolioWatch, or send us your questions and suggestions to portfoliowatch@abn360.com. Don't go away. When we come back, we'll take a look at stocks like Vodacom, British American Tobacco, and Walmart right after this break. Welcome back to Portfolio Watch, where we're taking a look at the pros and cons of buying Dividend Aristocrats. Now, to join us in studio to tell us more about this theme and to pick up on some of the stocks that one should consider is Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Nick Norman Smith, Chief Investment Officer at Lentus Asset Management. Now, just before the break, we did touch on companies like Johnson & Johnson, Coronation, as well as Franklin Resources. But let's throw Walmart into the mix. And many South Africans probably know this as the giant retailer, not only in the US, but of course having a stake within Massmart locally here in South Africa. Tell us more about this particular play, right? Quite a well-established brand that we have globally.
Yeah, so not quite the history of dividend payments that Johnson & Johnson has, but it's got 40 years of increasing or paying increasing dividends, which is also a fantastic track record. I mean, if you think about Walmart, the biggest retailer, 500 billion worth of sales, obviously coming under pressure in recent years given the e-commerce and Amazon story in particular, but still 3 times the size of Amazon. And I think if you're looking for inefficiencies in the market, I believe that the market today is very, very efficient. And to find inefficiencies is quite difficult, but if you're trying to look for it, just look anywhere that Amazon's looking and you'll probably find inefficiencies. And Walmart's been one of those that has come under pressure in recent years because of this e-commerce. But they've actually done really well. They're moving towards, so they're going from the brick and mortar to, they're moving in the opposite direction of Amazon to online. And they've bought, most recently, obviously, Flipkart in India. They've got a stake in JD.com. And then they own a company called Jet.com for many years, which is an e-commerce retailer in the US. And I think they've learned a lot of lessons by owning that business. Yeah. So, whilst they've been under pressure, it's still, I think, a fantastic business, 11,000 stores in 26 or 27 odd countries, sure, with a very big exposure to emerging markets, which is obviously our growth engines of the future. So I don't think Walmart by any stretch of the imagination is dead. It's not a company that we own, but when you're looking at Dividend Aristocrats, it's one that you find in that Dividend Aristocrats very, very often list.
So clearly one that we need to consider. You mentioned emerging markets, and we did touch on pharmaceuticals earlier on. One would certainly think that this continues to play a significant theme when looking at a Dividend Aristocrat. So AbbVie, introduce us to this particular brand, so especially for those of us who aren't familiar with it.
So this was actually spun out of Abbott Laboratories in 2012. So it's a bit of a cheat in terms of, it's actually only been around since 2012, but Abbott Labs has been around longer, and obviously pharmaceuticals is quite a good area. So they're a biotechnology company, but not the biotechs that one would think of that has one drug which comes off and the share price goes up 400%, or if the drug goes away, the company's sort of ended. These are much more established, some of these players. So AbbVie makes the world's biggest selling drug, which is called Humira. It's an arthritis injection, basically. Massively profitable.
Especially with an aging population across the globe, right?
Absolutely. Now, obviously, the risk with pharmaceutical companies is your pipeline and replacing it. What they've done very cleverly is a lot of their patents, and their patents around Humira are expiring. They've gone out and they've been very clever, because biotechnology patents, without getting in too technical, are a little bit different to protect. So you can actually get a patent on the way you make it, the way you package it, the way you deliver it, in a lot more ways. So they've built a fortress of patents, which the FDA and the US are not too happy about. But the reality is they've settled with their 3 biggest competitors who've got potential drugs coming out there. They've settled, they have basically exclusivity until 2023 from this drug, and then they've got a very exciting pipeline of other drugs coming out as well. So they've got this cash cow of Humira, and then they've got a number of other exciting cancer and other drugs that they're coming out and developing. And they've got scale to invest in R&D, and they've got a very successful track record. And obviously those big cash flows enable you to pay good dividends.
You mentioned the patents, you mentioned the R&D. One would think that they use a lot of this cash to recapitalize the business in order for further R&D and capital investment. Would that be a concern slightly to Aristocrat?
It's good because it's difficult to generate that amount of cash flow. So if you're one of the bigger players in the world, like a Johnson & Johnson as well, you can invest more. And if you invest more, you can earn more on a more sustainable basis. So obviously, the reason why it's quite cheap is that Donald Trump's been going on very hard against all of these pharmaceutical companies. Another reason why Johnson & Johnson is reasonably priced given the quality of the business. But we think those cash flows are pretty strong. And the reality is the legal system in the States is pretty tried and tested. So they're unlikely to be able to just go and suddenly pull your exclusivity. They do have a track record they need to keep.
Sounds like a fairly solid case, and of course looking forward to the growth and developments that come out from that one. Let's talk about a firm favorite for many South African investors and the telecom space, which has had its own experience of headwinds, but Vodacom always coming out as a leader when it comes to being a very solid dividend payer.
Yeah, so not necessarily one that increasing dividends year on year, but a very generous dividend payer if you look back over the last few years, and it's actually also been a very high yielding business. So if you're looking for yield, you know, Vodacom is fairly defensive given it's in the telcos space. Although you might not believe that if you had to look what's been happening at its main competitor MTN over the last few weeks. But I think, you know, Vodacom does also have a number of those risks that MTN, you know, might have obviously been exposed to Africa. However, you know, they're more East Africa as opposed to West Africa and Middle East, which I would venture is less risky. But we do know that operating in those regions, you know, does come, I suppose, with some sort of valuation discount. And we know also what's happening in South Africa from an economic point of view. You know, so Vodacom's been under pressure, you know, probably over the last year or so. There's obviously the regulatory issues around them as well.
Yeah.
But, you know, from a dividend payment point of view, from a sustainability and also, you know, where they're getting their growth from, when we look at their Safaricom acquisition that they made last year, M-Pesa, etc. I think for a longer term story, you know, whilst we make the shift, you know, from revenue more towards data, and these guys also continuously investing in their infrastructure to maintain their network, maintain their number one position in the network in South Africa. And then obviously the big thing in the future is the rollout of 5G, and when that comes, I think that's potentially a game changer as well. So I think there's a longer term story that remains intact, despite the fact that, you know, at the moment, sentiment is very negative towards telcos, you know, in general in South Africa, but in specific, I suppose, towards one company more than another.
You're quite right. We've previously highlighted a lot of those pressures, but even as you mentioned regarding telcos, those pressure on the revenue stream in order to diversify many more of its interests. Are we also still keen about the reinvestment into new avenues of revenue generation, particularly when it comes to the content creation, content generation, given that we're living in this digital age and that is expected to open up? What's your take on this, Nick?
Yeah, it's a very competitive space.
Yeah.
So they're clearly, a lot of these companies, Vodafone, their parent, are investing in a lot of, you know, content and television provision and IP television, etc., etc. It's a very, very competitive space because you've got these over-the-top providers and, you know, your Netflix, etc., that don't have to have all the infrastructure. So there's a lot of positives in that you own the customer already, you own a lot of the infrastructure. So I believe these businesses are going to turn into utilities if they aren't already. But what does, on the downside, that does mean they do have to invest a lot more to build the infrastructure on this data. The margins aren't as high as what you were earning on voice. So I do think we're in a space in the industry where these companies are undergoing a lot of pressure. I'm not convinced they're valued cheap enough for the new businesses they are. They've kind of gone from these go-go growth businesses. They're not quite value stocks yet, and they're sitting somewhere in the middle. So I think there is quite a bit of valuation risk there. Despite the fact that there are a lot of positives behind the businesses.
Yeah. Moving on to another company that's also received quite a bit of attention on the show here, British American Tobacco. Whether it's issues about sustainability, whether it's the long-term growth story, whether it's the offshore exposure that it also has in order to generate a considerable amount of revenues. But tell us why you like British American Tobacco. Is it still a key winner when it comes to being a dividend aristocrat? Yeah,
obviously there's a lot of pressure on these businesses. Everyone knows the negatives, right? You know, smoking's coming under pressure, etc., etc. The reality is it's still an addictive product that a lot of people want to carry on smoking. In addition, they are starting to generate a lot of investment in next generation products, so vaping and these sort of things, which is quite exciting for the business and actually a lot healthier. So who knows if that comes through, but again, you're paying probably 12 times forward earnings for the existing revenue stream with an option on some substitution in terms of these new next generation products. Now compare this business to Johnson & Johnson. Look how much money Johnson & Johnson, so they've got revenues I think of around $45 billion. They've got to invest between $10 and $20 billion a year on R&D. Compared to British American Tobacco, basically doesn't invest anything in R&D except for the next generation products, and it's a few £100 million. So the profitability of these businesses is massive. So and we believe that the opportunity is obviously the enhanced negativity around smoking, but these businesses have been very, very cash generative for a number of years.
Very resilient over the years as well. As we do wrap up, so often when we speak about dividend aristocrats and investing in high dividend yielding stocks, we often think about pensioners, and sometimes that's a misconception perhaps in the market in order for them just to retain a positive income stream. For younger investors, or again, depending on your investment strategy and the outcomes that you're looking to derive, how should we be viewing dividend aristocrats when it comes to the construct of our complete portfolio?
Look, I don't think a dividend aristocrat strategy is the be-all and end-all. I think a Dividend Aristocrat, gives you, a sense into, the quality of the business and its earnings, and the capital allocation decisions, that management are taking. But I don't believe you need to, only invest in those sorts of businesses. I also don't think that, sometimes just having a single dividend policy is the best way to go about it, because, sometimes an opportunity might present itself and it might be better off not paying out dividends and investing in this other opportunity. And you can also think of, there's a number of very well-known companies that have never ever paid a dividend and have done exceptionally well. They reinvest, they believe they can reinvest that capital better than at higher rates of return as opposed to returning it to shareholders. Berkshire Hathaway is the obvious case in point here. So I think a Dividend Aristocrat gives you a very nice view into the boardroom thinking, the quality of the business, the quality of the earnings, but by no means is it the be-all and end-all when thinking about what shares to invest in or not.
Going back to the number one rule of investing, diversification, diversification, diversification. Well, a big thank you to my guests for joining us this evening, Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Nick Norman-Smith, Chief Investment Officer at Lentus Asset Management. And not to forget, thank you for tuning in. And of course, hopefully you've gained more insight into, number one, identifying Dividend Aristocrats and how you can consider some of the stocks we've suggested this evening. Now, keep your questions and thoughts coming by tweeting us and joining the conversation at CNBC Africa, #PortfolioWatch, or email us your thoughts to portfoliowatch@abn360.com. Until next week, have a wonderful evening.